So today is Tuesday, October 14th, 2025, and right now it's the end of the trading day. So we're just going to review what's been happening in the market, and it's really just an opinion piece about what's been happening. So as we all know, on October 10th, there was a sudden escalation in trade tensions with China with the U.S. As a result, the market was more or less blindsided by that, as we all thought tariffs and all that was pretty much in a weird view mirror, but it's at the forefront in advance of the meeting with Chairman Xi and President Trump. So the market took a dive on a Friday. Then I think everyone kind of realized it was a bit of a taco trade, where Trump came out and said not to worry. Markets rebounded in on a Monday, dropped again with new escalations, and now it's more or less in the green again. So, long story short, with all these tweets or truths on Truth Social, the way I see it is just, it really is just negotiation, public presentation in preparation for that meeting. I think, realistically, Trump is not dumb, neither is Xi. These guys are, good negotiators, experienced negotiators in high stakes, negotiations. So I don't think neither country wants to have more difficult trade. Obviously, they all have their own agendas, but I think for the most part, they probably do want the meeting to happen. They want the tensions to decrease, but at the same time, they're kind of testing out what the lines are, dipping their toes in different areas of negotiation, and just seeing how the other responds. So there's really not much more than that. The fact that the markets are selling off, either one is institutional players are, they're just not interested in being part of that volatility. They might think that the market is frothy, and they're just trying to exit, and they don't want to be part of that. Or it just might be retail traders that are, really trading on that news. But I think for the most part in the past couple of years, the rebounds have been happening quicker and quicker. So with that said, we'll go over some of the movements today in the different areas of the market. So as you see, pretty much all areas of the market has been increasing for the most, primarily in the value small caps, before the large cap growth, which I believe are most indicative of the technology stocks. That has been pretty much the only ones in the red today. So as you can see, all the sectors are up: consumer staples, industrials, financials, materials, real estate. These are all up by good amounts. This might also represent a rotation out of technologies, which is down, and into the consumer staples and the more defensive ETFs and indices of the market. You also see that Bitcoin is quite much down. I believe it was over 124,000 at one point earlier last week, and now it's only at 112. So that took a pretty large dive. Emerging markets are down as well, and developed markets like Japan, United Kingdom, Australia. So these are back in the green. Gold is up over $4,000 per ounce. So it's overall, I would say, very much a defensive rotation into the defensive stocks and assets. But at the same time, it seems that investors don't really want to miss out on what could potentially be a bounce or a continuation or a broadening out of the trade away from tech, away from AI, and they don't really want to be too caught up in, cash yield being assets like treasury bonds, and so on. So let's take a look at the market movers. Today for the S&P 500, it was pretty much a gainers day with over almost 400 gainers in the market, with only about 113 companies that have decreased. And for the most part, you see Arista, AI infrastructure, NVIDIA, Intel. These are all companies that are down quite a bit, all tech related. You do have Goldman Sachs there, JP Morgan. But for these, you have on the gainers, you have Walmart's, you have the Caterpillars, you have the Delta Airlines, Domino's Pizza, United Airlines. And also just looking at the 1 day performance. So you'll see that obviously we know the majority are gainers, but also for interestingly, the volume is quite high as well. I mean, a lot of times you'll see the dots clustering in the mid on the left side, but today it's quite dispersed, and I would almost say it's the volume is higher than the relative volume is higher than normal. And then also let's take a look at some of the market indexes. So you have the U.S. sectors. So these are representative of all the different sectors of the market. You'll see, so that is the points, but then you have the percentage change. So for the technology, that's down the most, energy down a bit. So we talked about this earlier. It's been more or less a rotation today into more defensive sectors like consumer staples, industrials, materials, and so on. So just taking a look at let's take a look at the year-to-date performance. So there was a big drop, as we all remember, back in April. So the best performer right now is utilities, with technology in a close second. But then we have, so we have financials in the middle, and we have the laggards in materials, discretionary healthcare, as we all know, with Robert Kennedy Jr. That hasn't been doing too great. And so utilities is the one that's doing the best. So that kind of tells you where the market is at right now. And looking at just the 1 day performance, so we have this group of healthcare, discretionary, energy, staples really above the crowd, and technology is well below it. And I also like to get a sense of what different countries are doing. Ignore the graph here, but you can just look at primarily here. You have the 4 sections: Americas, Asia Pacific, Europe, and Middle East, Africa. So taking a look at the year to date, pretty much everyone is up. You have Peru at the very top of the Americas. You have South Korea, Greece, South Africa. I would also precaution, I believe these are not inflation adjusted. So I recall, I think a while back we were looking at, Argentina maybe a couple years back, and it was well above, the performance was amazing, but it was also because their inflation was out of control. So I believe because a lot of these ETFs are dollar denominated, with the devaluation of the dollar, that has also sent a lot of these country ETFs much higher. So we have to adjust for that if we actually want to look at the performance. But overall, you can get a sense of which countries are doing better or worse than others. Factor analysis just tells us a bit about what has been working well, or the different factors, whether it's small cap, momentum, growth, low volatility. Overall, the momentum trade has done very well, I believe. Or let me look at the 10-year. Yeah, so momentum, growth, those strategies have done very well compared to low volatility. And that's really just representative of the big tech stocks that have done very well over the past decade, since I believe the 90s. So if you want to look at how the qualitative aspects perform, like the buybacks, spin-offs, hedge funds, IPOs, you can look at that too. Global yields is another favorite of mine. So if we look at, so effectively the yields is supposed to be negatively correlated with stocks because in times of recession or fear, people are supposed to sell their stocks and buy bonds. And by buying bonds, the yields are supposed to go down. So for the year to date, you have the U.S. 10-year yield is really what I like to pay attention to. So, as that's usually the benchmark that people use in comparison as the risk-free rate for stocks. So you'll see that beginning this year, we were at a high of about 4.7%, and it's been steadily going down. And that could be, I mean, it's a combination of factors from the economy slowing down, expecting inflation to decrease or going to a lower amount, and also expecting the interest rates to go down, and that gets reflected in the yield as well. So so that just tells me that people are expecting there's a lower inflation, people are expecting the interest rate to come down, but also as a result, that also pushes the stocks to go up because of the lower cost of capital that companies have to pay on the US 10 years. So that's also a benchmark rate. And if you look at the course of over 5 or 10 years, you can kind of tell like where it's been at and how it affects the economy. So before, it's been very, very low, as sub 1% in 20. It doesn't really show before, but pre 2016, it's also it's all pretty much been 1%, 2%. It's always been pretty low. It's only since COVID it's come up quite a bit. So there is room for this to come down as well. And if it comes down, it has a lower cost of borrowing for companies, which allows them to pursue more growth. And then for currencies, you have the US dollar, basically the currency matrices or matrix. So year to date, you can see that. This matrix was a bit confusing, but effectively, what I go by the column here or the rows here, and if it shows a negative, it means that the US dollar has depreciated 10.9% or 10.8% against the euro, 6% against the UK pound. So you can see that from this matrix, you'll see some patterns here that euro overall has appreciated against all these different currencies. The Swedish krona, I believe, also appreciated against these currencies. So you have to look into also why that's been the case, right? But overall, I think the pattern that we can see is the US dollar has been decreasing quite a bit. There's been a lot of talks about the de-dollarization, but in my opinion, it's also a strategic decision of the US, because how do you get more exports? You have to lower the price of the US dollar to make US exports more attractive. If you don't do that, then it just doesn't. It's harder for other countries to import US goods. So I think that is actually part of the overall trade strategy that the administration has to lower the valuation of the dollar. And going back to commodities, so here you'll see different commodities that like silver, gold, and just how they've performed over the past year, past month. So just going back to the dashboard here. So overall, I think, I think there is a lot of fear in the markets right now. I think investors are still holding on to equities or defensive ones, not to miss out on the potential upside. But overall, when we look at the overall market for the US, I mean, we have to understand the market is a reflection of the earnings potential of all these different companies. With NVIDIA, with AI, I think for AI, I mean, the very fact that it is a race between the US and China, and we have to understand that it also goes a bit beyond what companies can make, right? I mean, for example, if the growth of AI slows a bit, or if the profitability still, takes another year to come, and so on for all these different AI companies, does that mean the US is going to stop or, you know, deter companies away from investing in AI? They're not, because they see it as a potential race with China. So as long that belief is still in place, there will be continued investment into the companies, or I guess the push for the market to support these companies. And it's not like, these companies are pre-revenue like they were in the dot-com era. I mean, these companies are some of the most profitable free cash flow generating companies out there. So for example, we take a Google and we look at their financials. Under highlights, just give it 1 second. Yeah, so taking a look at the cash flow from operations, they're generating over $125 billion per year. I think they can afford, a few $1 billion in capex investment. So overall, I think the market still has room to go. I think there's a lot of jitters in the market right now. But overall, pick your right stocks, pick your right ETFs that you really believe in a long-term basis. And I think, once we get through this patchy period, I think overall, there shouldn't be much issues to continue AI trade, to continue optimism around AI technology, and the picks and shovel trades around that will still continue to play out. There might be some headwinds with tariffs, but that's more isolated in companies that are still exposed, despite knowing that this has been a risk for the past, really, since Trump won, for 10 years now. If they haven't really diversified away from China, that's really on them. So pick the companies that are isolated from or insulated from the terrorists as much as they can. Pick the defensive stocks, place the stocks that you believe that will go up in the long term with good fundamentals, and I think overall you'll be fine. So that's just my opinion. So I'm adding exposure here during this time, getting some call options as well. And yeah, I think once this period goes over, it'll be another, there might be a bit of pullback, but within the next year, the market, I think, will be higher than this time this year.